What's up, guys? I hope everyone's doing good. If you clicked on this video, it's probably because you're wondering how you can make an extra $500 per month passively. Quick spoiler alert, it is with dividend/income investing. Let's get into it. For the metrics, $500 a month does not seem like a lot, but it is essentially $6,000 a year. So if you think about it, $6,000 a year could pay for your vacation, could pay for your car repairs, it could pay for a few bills, it could pay for a lot of things, or it could just stay on the side and be reinvested. It is $115 a week or 16.45 cents a day, which pays for your coffee if you do buy coffee every day, or if you have a daily recurrent payment that you like buying a snack or whatever, it pays for it. Yes, it does not seem like a lot, but it's some extra money in your pocket to have a bit more freedom and do whatever you want. So yeah, what's the point of this? It's basically to get wealthy, and for me, wealth is when your passive income surpasses your expenses. So I drew a little graph here, and the white line is basically your passive income that is getting reinvested and reinvested and reinvested over time. And let's say you invest in something that generates 12% a year. So essentially it generates 1% a month. Then every time you invest $1,000, it adds $10 of monthly income to your personal passive income, like reserve. Yes, it does not seem like a lot, but that $10 a month ends up adding $120 a month to your income at the end of 12 months. And if you do that for a few years, it just keeps stacking up and stacking up and stacking up. And at some point, it just outgrows your expenses. That's where I think personally, you get very, very wealthy, is when you have so much passive income that you can't even spend the whole thing and you have some leftovers. And when that gets reinvested, it just keeps growing and it outgrows your expenses to a point where you're not able to spend as much as you make. I mean, why would you invest in passive income and not invest in growth or whatever? Is maybe you don't care about having $5 million in the bank. Maybe you just want freedom. You just want income. You don't want to be tied to your job. You don't want to stress about losing your job, because if you lose your job, well, you're making $500. That's not a lot, but after a few years of compounding, you'd be making $4,000, $5,000, $10,000 a month doing nothing. And then you're at a point where you can just chill, like this guy in a mountain, or on the right, you have a nice apartment, your rent is getting paid for, your mortgage is getting paid for, and you don't have to stress about, shit, I just lost my job, I'm fucked, you know? What are your options? Made a quick table with a few tickers as an example. So you have dividend growth, which are your most popular SCHD. You have O Realty Income, you have Divo. So these are more dividend growth, so they don't have a high yield, but every year their yield get increased by a lot. And so on the short term, it doesn't pay a lot, but if you hold these in the long run, they should outperform all the more aggressive ones. But it really depends on your goals. If you need the income now, or if you're ready to sacrifice income for more growth, that's an option. There's more conservative covered call ETFs like JEPI, JEPQ, KQQQ from Curve. These range between 6 to 9.5%. There's those covered calls ETFs, which are mostly around the 12% range, but they can go up to 20%. Like SPY-I on the Canadian market, there's HYLD, and there's SPY-T, which is 20%. There's those aggressive covered calls ETFs, which have a bucket of stocks. They sell covered calls, but they have a bit less stocks, so they're a bit more volatile, a bit more risky. And in exchange, you're able to get a bit more distribution at the end of the month. So these have yields of 25 to 55% in general. Really, you have to do your research. Really depends on which one, but their yield are up there. And then there's the 0 day to expiration ETFs, which are very similar to the aggressive ones. They're also kind of aggressive, but they basically sell options on a daily basis. And most of them, they pay their distributions on a weekly basis. So an example would be XDTE, YMAX, QDTE. They range from 25 to 45, sometimes more, depending on how volatile the market is, sometimes less. And then we have those single stocks ETFs, which are much more risky because you're basically selling covered calls on a single stock. So it's a lot more volatile, much more risky, because you're putting all your eggs and you're betting on one single stock. But in exchange for that, you have a much higher yield, like Misty, NVDY. These almost have 100% distribution rate, and their performance has been crazy if you go look at the total returns. Apply, which is on Apple, Amazon, which is on Amazon, and Goop, which is from Curve on Google. These are just random examples. There's all the big stocks that you like that are very popular. They all have a covered call ETF associated to them, most of them. Now, how much do you need? I just built this little table here. For 3 to 5%, you need from 120 to 200K to make $500 a month. For 6 to 9.5, you would need about $65 to $100,000. For the 12 to 20%, you need between 30 to 50K. For 25 to 55, between 10 to 24. 25 to 45, which is, these could go in the same category. Let's just say the same thing, 10 to 24. And then for the single stock ones, 17%. At the 17% ones, you would need $35,000. And 100%, I mean, if you want to make $6,000 a month and your yield is 100%, you just need to invest $6,000. They're much more risky. But literally, these are the numbers. So it's crazy, but it's possible if you really wanted to. When you have all this information, what should you do? From all the data that I've seen, the sweet spot is between 12 to 15% yield. This is the yield where we still have a bit of growth and the price is pretty stable because they do distribute a good amount, which is about 1% a month, but they do not sacrifice the NAV to be able to pay their investors. The asset price basically follows their underlying. For example, SPY, it follows the S&P, but as you can see in the last year, it grew 1% compared to the S&P here, which grew about 16%. But then you have to add the distributions on top of that 1%, which are about 12%. So in the last year, you would have made a total return without reinvesting your dividends of 13%, with reinvesting a bit more. So you're not far behind VOO. But again, when you think about the why, if you're an income investor and your goal is to generate passive income, and that's what makes you happy, and that's what allows you to stick to your plan, then you don't really care about maximizing your total returns. If that's what you want to do, then just, I don't know, go invest in growth, If you're an income investor, you know that you're going to have to sacrifice a bit of growth for income. Here, just to compare SPY and SPY, as you can see, they're both doing the exact same pattern. It just really depends on where you bought it, but they have the same performance. It just, SPY has a little gap and it's on the growth side. It is outgrowing SPY because SPY are covered calls, so you're sacrificing some upside for income. You have HYLD, which is a 12% one, but HYLD has a 25% leverage, which is pretty modest, and it's not a crazy leverage. Because it has 25% leverage, it's able to offset that limited upside. So yes, you do not get as much upside as SPY, but since you have a 25% leverage, when the market moves up or moves down, HYLD is able to catch up to the SPY. The growth of HYLD is not stunt as much, and then you can add these distributions to the growth, and it's basically sticking side by side with the SPY, which is very impressive and very cool that you can generate income and not even lose on the upside of the SPY. I mean, based on this information, I would say just do your own research, find what works for you and stick to it. For me, I think that 12% to 15% is a sweet spot. So on my personal portfolios, where I could make a video on that another day, my anchors are really 12% yield positions. These are my portfolio anchors or pillars. And then around that, I have some more aggressive stuff like YMAX, YMAG, single stocks. And I also have some dividend growth just to complement have a bit of everything. I also have some 100% growth in my portfolio. A mix of everything is good. And if you go all in on one, just make sure that it's something that you like and that you believe, because when the market drops, you have to be ready to buy more and not panic sell or just hold to your positions. I see a lot of people on Twitter who've been all in on single stocks or YMAX, and they even got margin on those positions and they have crazy positions, but all they think is boost their yield. But they don't think that it's more risky. And now that the market dropped a bit, they get margin called and they are like, oh shit, I'm going to trim my positions and buy something else, At the end of the day, do your own research, start with what works for you and stick to it. Find something that you're comfortable with. Personally, I started with dividend growth just to build a bit my tolerance to investing, dividends, everything. I really liked it. And then I slowly built my positions in HYLD and 12% about covered calls. I DCA'd, I built my tolerance. And now, even if the market is dropping, I don't care because I still get paid my distributions. So yeah, just build your tolerance and find what works for you. At the end of the day, that's what's more important. So yeah, that's it for the video, guys. So I just wanted to show a bit what's the possibilities. It's not that hard to generate $500. So based on my personal sweet spot, which is 12 to 20%, I would say that you would need to invest about $30,000 to $40,000 to be able to make $500 a month doing nothing. And that is just $500. So if you want to make 1,000, you could just double that. If you want to make 10,000, you can times 20 it. So that's just a number that you can scale. I think 500 is pretty realistic. I think if you have a job that is not bad paying, and you don't have crazy expenses in life and you're able to put some money aside, you could easily build a portfolio that generates you $500 a month. And from there, at least you have a baseline income. If something happens, you have an extra $500 a month that you can go pick and kind of save your butt if something bad happens. And if nothing bad happens, which I hope for you guys, then that $500 a month could just keep getting reinvested until one day you need it. And if you never need it, it just keeps compounding. From the graph I showed you earlier, at some point you'll be making so much passive income that you'll not be able to spend as much as you're making. And that's the goal there. So yeah, guys, until next time, take care.